Listen, Michael, let me tell you how this works. I do it. I dump the markets, big dump, everyone's crying. I start the recession fears, total fear. The media eats it up. Then I cut the rates I tell them to, and boom, everything goes up. Stocks, Bitcoin, everything. And guess what? I buy the bottom. I always buy the bottom. Then I say, let's pivot. And the bull market begins. It's beautiful. I run the whole thing. They don't want you to know that, but I just told you. You're welcome.
Ladies and gentlemen, boys and girls, welcome to the meltdown. Stocks are falling apart, but we did get a little bit of a bounce today, and we're going to talk about why and what it means. Stocks were up in a pretty big way. Some of the big movers did move today, but there was some weakness under the hood as well that we're going to talk about. We're going to talk about the inflation picture. Egg prices are down. We're going to talk about why. The government shutdown is approaching and why the government probably will shut down, what it means for your portfolios. We're going to talk about recession, some dumpster fires happening in the market, and of course, Adobe as well. Now, guys, welcome to FinFluential Media. We are going to talk about everything. Today, we're going to talk about stocks in the financial markets and see where things go. So let's actually quickly recap what we did today. The NASDAQ 100. These are the 100 biggest stocks on the NASDAQ exchange, including companies like Nvidia, Apple, Microsoft, Tesla, even members like Costco, Adobe, a whole bunch of them in this index right here, up 1% today. But it's been a pretty terrible year for the NASDAQ 100, down about 4 or 5%. But we're seeing a little bit of a tactical bounce, definitely some volatility here in the market. We'll see if this can continue. And for those of you that are unaware, it's sort of around this time right here in March where we actually put in a low, and then we do continue the rally in the average year over the past 20 years in the S&P 500. In fact, the weakness we've seen from mid-February into March is completely historical normal over the last 20 or so years. So if we actually continue a rally, taking our all-time highs, making higher highs, and maybe even finishing at the top end of 6,600, that is completely normal to be expected. It's what we would seasonally expect. There were ups and downs today in the market. Apple got a downgrade from Morgan Stanley. It was down 1.75%. They decreased their price target from 275 to 255, citing artificial intelligence and a delayed upgrade cycle. The Apple's upgrade cycle just keeps getting delayed. But counteracting Apple, Nvidia gained 6% today. Very big move here. So the mega caps, some positive, some negative, but Nvidia, holding the show together. High beta also gained today. Robinhood and all of these retail growth names was up 7%. So we're definitely seeing a tactical bounce happen. We'll see if this can continue. Value also performed today, seeing a pretty good bounce, 2.48% in Evolution, a stock I own. And we saw staples, consumer staples, these defensive characteristics, they took a backseat today. Coca-Cola down 1.55%, among others. Now, the move today was actually on the back of the CPI print. Okay, we got cooler than expected CPI, and the writing was on the wall. Egg prices are officially below when Trump took in office. Trump took office about here, the 20th of January, just after 2025. Yes, we did see egg prices soar, but we've seen them absolutely plummet. Now below post-Trump's inauguration. So, egg prices have been a huge media frenzy thing. I wonder if they'll keep up the media frenzy. But the big thing that's going to permeate the markets over the next couple of days is the gap funding bill. A bill officially passed the House. It now has to go to the Senate. And the Senate needs 60 votes. They need 6 Democrats to vote yes on this bill. Chuck Schumer says Democrats will block the GOP funding bill, heightening a shutdown. So we likely are going to see a government shutdown. I'm not aware of the particulars as to why, but we'll see what happens with the House vote. This is all speculation. I don't know if we can actually trust any of these media sources, but ABC News is reporting that Democrats are likely going to block this bill, so it won't pass the House and get a government shutdown. But is that cause for concern? Generally speaking, no. If we look at the long-run average of government shutdowns, whether Democrat or Republican, you can see that the average return and median was 12% 12 months higher, just above 12%. So when the government shuts down, actually you want to buy that dip. 84% of the time, we actually finished higher 12 months later. So a government shutdown to a degree is actually pretty bullish. Now, will we get a recession this year? Betting markets say we are 38% of the way there. This is Kelshi markets. They say a 38% chance of recession in the US. Recession odds have skyrocketed recently, but still down from what they were in October, August at the end of 2024. So the market's still not at peak heightened fear. And I don't think we're going to get there. I just don't see the writing on the wall for a recession this year. But certain stocks are definitely pricing in a recession. Guys, private equity names are taking it on the chin. Private equity stocks, stuff like KKR, Blackstone, Apollo Global Management, they're all down 20% year to date, right? You're looking at close to 35% declines from peak to trough here. And this mostly has to do with a Trump administration. The Trump administration wants to deregulate. They want to allow banks to actually make loans. This means there's a limited need for high yield private credit. And if this is the case, where do these stocks go from here? Likely down to sideways. But we'll see if that is the case. These companies, these stocks, these management teams are very, very flexible. They will always find a way to make money. They've also penetrated the financial markets in a very, very deep way. And they're not just going to vanish out of thin air. They will still make billions of dollars in profit every single year. It's just the market now needs to re-rate them based on future returns, earnings, etc. Now, guys, we had earnings today. Adobe reported earnings. They were down 4% here in the after hours. We actually kind of flatlined until the earnings call, and then things took a turn for the worst. Now, Adobe's earnings on the quarter was actually pretty good when you look at it in aggregate. Revenue beat, media and experiences beat, guys, operating income beat, margins beat, EPS beat, cash from operations. It was only RPO that missed ever so slightly. This is a remaining performance obligations missed ever so slightly. But why the stock was down, but the reason why the stock was down 4% actually had to do with guidance. Q2 guidance, or the next quarter's guidance, as well as the full financial year, missed on almost every single metric. And the street doesn't want to expect this. Now, I think for the most part, Adobe is really protected from tariffs and that type of stuff. I think the reason why, they lowered guidance probably has to do with AI, image generation, image AI editing, that sort of stuff. This has really weighed on Adobe's stock. I would think the street wants to see that when you have your moat eroded because of AI, you're going to get the stock sold off. But I thought the stock was going to be down 10 to 12% when I actually saw that guidance. It was only down 4%. So it probably goes to show that a lot of that was already priced in. And the expectations coming into these earnings was probably already low. That is why we only saw it 4% drawdown and nothing more. So now we have to ask the question, is Adobe a buy right now? And we'll go ahead and have a look. So in the last year, the stock is down 21%, when the S&P 500 is up about 20% in the last year. Now, looking at the financials, do we have the most recent earnings? We do. So $22 billion in revenue, so still growing 10%. This, as it is right now, there's nothing fundamentally wrong with this company. It is growing. You could see that cost of revenue pretty low. That's a pretty high margin business. What is it? 85% gross margins. Let's have a look right here. 89% gross margins, 36% operating margins, 41% free cash flow margins. So a cash generating machine. They reported free cash flow on the quarter of $9.1 billion. Are they buying back stock? Let's have a look. Shares outstanding down 2.86% for the year. So they've definitely ramped up buybacks, as the stock has not done much in the last year, down 20%. So looking at these financials, looking at operating income, looking at the interest expense, only they have very minimal debt, it seems. The interest income surpasses the interest expense. That really goes to show they probably have a net cash position. Let's have a look at their balance sheet. So they have $6.7 billion in cash equivalents, cash and short-term investments of $7.4 billion. What is the actual market cap of this company? $190 billion. That's a pretty sizable cash position. Now let's go ahead, look at total debt right here at $6 billion. So very, very healthy. Long-term leases, Total liabilities of 16 billion, total assets of 29 billion. So it's a very healthy company, a very financially sound company. This is the type of stuff you actually want to see in the name you're buying. Looking at the cash flow, we've already looked at this. Free cash flow is $9.1 billion. And then actually, let's have a look at some ratios right here. So return on equity, 47%, return on assets, 17%, return on invested capital and ROCE, 25 and 38%, a 3.54% earnings yield, 4.13% free cash flow yield. Just for record, you want this number right here at or above the 10-year yield. 10-year yield at about 4.2%. So this is actually a pretty attractive free cash flow yield, especially considering that there's a growth component to this, whereas a treasury yield won't ever grow. They're buying back shares and total shareholder return is 2.05%, so they don't pay a dividend. It seems. Let's go ahead and look at the forecast. Now, analysts say Adobe is actually a buy. The average price target is $566. That will represent 29% growth from the current price. So maybe this pullback we're seeing here in the after hours of Adobe could actually be a buying opportunity. At least the average analyst says yes. But I don't think we have the most up-to-date analyst estimates. Let's have a look right here. 10th of March, 2025. Citigroup actually put on a hold, maintains their hold rating, decreased their price target to 490 from 551. That's pretty much it. Yeah, it looks like we're seeing downgrades across the board in price target, but still having a buy rating nonetheless. Now, what is Adobe set to do? They're looking at growing revenue 11% year in financial year 2025, 68% EPS growth. So look, they're looking to really cut costs and build some operating leverage, increase unit economics. So that is some pretty big EPS growth right here. And that will put the forward PE at 21 times, very attractive on this year's earnings, 21 times, 18.6 times on next year's earnings. And it looks like we probably are going to grow about 10% on average over the next 10 years. Earnings looking to grow in a much more robust way. I mean, right now, you're looking at earnings per share of close to $12. This is almost set to double, more than double by 2027. And we're about 90 days in through, and we're about 70 days through 2025. Very interesting when you look at this. So Adobe looking attractive on a PE basis. If we go back to the financials and we go back to ratios, right? You could see here that forward PE 21 times, sort of around there. Look at the EV to free cash flow trading at 24 times. EV to EBITDA. So these are looking a little bit pricey in my opinion. I like to see these figures at about 22, pretty much at what the PE multiple of the market is. That's what I would consider them attractive. So, Adobe, I would say at the current price with the 4.1% free cash flow yield for where the 10-year yield is, and also looking at some of these ratios, I would say that Adobe is probably fairly valued. However, this is a very high margin business, and they do have some incredible return on invested capital metrics here. My favorite metric is this one, ROIC, but these other metrics show that Adobe is using debt and their overall asset base very, very well. So is Adobe a buy? I would say yes. I would say if you've got a long-term time horizon, Adobe is a buy, but this is without going to say that there is some structural headwinds that this company is facing with AI, and that is something I'm not including. So yes, I would say Adobe is a buy right now, but a buy with caution, and maybe I would keep it an underweight in your portfolio. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button. And guys, leave a comment for the algorithm. Cheers.